Hello, TheoTraders. This is Doc Severson for the nightly report for Tuesday, April 26th. You know, the last couple of days we've had some pretty bad tech earnings through Microsoft and Google, and now, as of tonight, Apple has gone up to the earnings confessional and whiffed. Sales fell for the first time since 2003. This is not good. This is really not good, and not only did they miss on the top line, but also the bottom line as well too. So what we have to watch for is this kind of domino effect where one by one these tech companies are starting to lose earnings. Now, tech was really the driver for the market over the last several years, with energy being very, very soft over the last 2 years or so, and tech was always there driving innovation and corporate profits. So this is the beginning of a really bad trend right now to see tech miss again and again. Now, here is the chart on Apple today, and what I'm looking at here is the after hours session. So you can see that Apple, after kind of a drifty day to the downside, finally started reporting and immediately got hit really hard out of the gate. Now, what's interesting here is to note how the stock had a reaction at about 99. If you remember from Don's video last evening when he talked about how to trade Apple earnings, one of the things that he said was, hey, look, over the last several earnings reports, Apple has traded to the downside. So it now has a new trend to the downside on earnings releases. So this certainly came to play tonight. The other thing that he brought up was to say that the expected move was going to be roughly about 5 points or so. And if you averaged up all of these earnings releases over the last several data points, the last several years, they averaged about 4.5%, 5% or so. I don't recall the exact number that he brought up yesterday, but basically what he was putting in is that the expected move was pricing in about that amount. So remember also when we talked about the expected move here, the 68% figure, that prices are typically, in this case it was about plus minus 4.9%. So we were looking about a 10-point expected move range into here for Apple. And right at the expected move lower barrier, we did get some support coming in, a little bit of buying, a lot of limit orders coming in right at the bottom of that expected move. But those quickly got overwhelmed, ate through that supply, and right now you can see that we're well below the expected move. So you can see that 68% of the time, 68.3% of the time, we're going to be seeing a move that fits within the expected move. But the other 32% of the time, you're going to be getting a move that's going to be, part of one of these fat tails. Okay, and so far we're getting a fat tail move. Right now, that is well below. Those are really bad numbers, and it's not surprising that Apple is getting taken out behind the woodshed right now. So the lesson here over the last couple of videos is think about your trade logic. Just because you always end up doing iron condors and selling premium around an earnings release might not give you any room to be able to make a profit on these trades if you don't have your trade logic set up correctly, if you don't look through the data and figure out whether or not you have an edge. Don't forget, guys, starting tomorrow, we'll be continuing with the Options 201 series. So Options 201, and that's going to be starting with calendar spreads. So looking at a very simple time spread and the work that we need to be able to do to qualify a time spread to get edge in our favor. So that starts tomorrow, and that starts at about 9:45 Central Time, and that's with Don. So thanks for listening, folks.